I think the reason they haven't revalued it is because they want to keep gold out of the public conscience. Because if they revalue, people are going to realize that the emperor dollar has no clothes, and that gold is the ultimate.
You're watching Silver News Daily. Subscribe for more.
The Federal Reserve has been caught red-handed, and what's inside their own essay could ignite the biggest financial firestorm of our lifetime. Behind closed doors, they're openly discussing a gold revaluation, an emergency reset to try and salvage the collapsing dollar system. Think about that for a moment. The very institution that has spent decades defending the dollar's supremacy is now admitting it can no longer hold the line. It's the ultimate confession that the emperor dollar has no clothes. And here's the real shock. If gold is about to be revalued, silver won't just follow. It will detonate. Unlike gold, silver is scarce in both financial and industrial markets. Investors are already piling in, and the BRICS alliance declaring open economic war on the dollar is only accelerating the panic. Sovereign debt is spiraling, central banks are buying gold at record levels, and the world is scrambling for any hard asset outside the fiat system. We are not just talking about a price rally. We are staring down the barrel of a monetary earthquake. Gold might move first, but silver's move could make gold's gains look tame. The stage is set for a parabolic surge, and the countdown has already begun.
And what the artificially induced interest rates have done, especially from like 2008 to like 2020, 2021, is that it's encouraged people, corporations, governments to take on more and more debt because rates kept moving lower. Like even before 2008, we were in a downward cycle for interest rates. So it was really easy to take on debt because you could roll over that debt at a lower cost. And that drove asset bubbles, that drove real estate bubbles. And it made people really, it made it so people thought everything, and still think, I think to some extent, that everything is easy to get, that you don't need to do any work. You just borrow, speculate, and you spend and keep repeating it. And it's not natural. And the central bankers are to blame for that because they pushed this policy of zero rate and QE. And unfortunately, Elijah, all good things come to an end, and then interest rates will revert, not to the mean, but it will go through the mean, which, looking at that chart from that book, seems to be around 5% for the last few hundred years. I think we're going to blow right through that mean. We're already near 5%, and we could even see double digits interest yields in the next few years. And basically, that's payback time, really, for the decades that we've had of easy money and living beyond our means.
Silver has done what many thought was impossible. It's blasted through the $41 barrier, a level that stood as a fortress for over a decade. Just weeks ago, gold pushed past $3,550, but silver's percentage gains are leaving it in the dust. As of today, silver trades at $43.15 an ounce, marking a staggering 43% gain since the start of the year. That's not just a rally. It's a breakout confirmed by real market stress. Look at the evidence. Inflows into silver ETFs in the second quarter alone totaled 95 million ounces, more than the entire inflows of last year combined. COMEX deliveries in July and August shattered records, and premiums in the physical market are running 20 to 30% above spot. These aren't just numbers. They're signals of a market starved for supply. Inventories are shrinking, demand is overwhelming, and the cracks are spreading wider every day. Even the big banks can't ignore it. JP Morgan has already raised its forecast toward $40 with upside to $45 if deficits deepen, and HSBC has bumped their 2025 average target higher on the back of gold's surge and geopolitical instability. The consensus is forming. $40 to $50 silver by year-end is not a dream. It's a probability. The old trading ranges are gone, and the new floor may be higher than anyone expected. Silver has broken free from its shackles, but this is only the beginning. Because while the breakout is confirmed, the technical setup behind it points to something far more dramatic on the horizon.
Yeah, on a personal basis, I don't think it's the end of the world. People are just going to have to adjust to being more frugal, working harder, saving more, and doing less and spending less. I mean, going back to like 50, 60 years ago, when the credit bubble wasn't there. In terms of the markets, it's not the end of the world either, Elijah. I think it will bring back what some people call value investing. There will be places where you can invest that you will do well, but you will actually have to do some work and research. There might not be as much capital appreciation and bubbles as we've seen the last 20, 30 years. So, yeah, to some it will seem like the end of the world because they've been around only, not a very long time, and they don't look at history and realize that things go in cycles. So, yeah, that's how I.
The charts are screaming a message that few are willing to hear. Silver is setting up for a super spike. After gold peaked in April at $3,500, both metals consolidated for months, shaking out the weak hands. But now the picture is clear. Silver didn't just survive the consolidation, it led the breakout. A surge above $38 in June triggered a cascade of buying that catapulted it 20% higher, and the momentum hasn't slowed since. Technical indicators confirm what the fundamentals are shouting. Silver's RSI on the weekly chart is sitting at 68, strongly bullish but not yet overbought. That's the sweet spot where rallies gain traction without burning out. Trading volumes jumped 30% on the breakout, while managed money net longs are up an astonishing 163% year-to-date. Even commercial shorts, typically the most powerful players in suppressing silver, are stretched to multi-year highs. Pressure is building, and history tells us that when the coil finally springs, silver doesn't just rise, it explodes. Think back to silver's past parabolic moves. In 1980, gold doubled, but silver multiplied nearly tenfold. In 2011, gold broke records, but silver slingshotted from $9 to almost $50 in just 3 years. Every major gold breakout in history has been followed by an even more violent silver rally, and the current setup is no different. Analysts are already projecting $50 plus targets by early 2026, with some models showing potential for much higher if the squeeze takes hold. This isn't just a technical story. It's the prelude to a geopolitical earthquake that is about to shake the very foundations of the global monetary system.
Definitely, and I think the summit you had in, I think it was Tianjin in China, for the Shanghai Cooperation Organization was like a big turning point because India attended and Modi attended for the first time in 7 years. And it looks like India, China, and Russia, the big countries in BRICS, are very united. And then you had this military parade commemorating the end of World War II in China. And Xi Jinping was really flexing his muscles there. So, yeah, and talking about a new order, Chinese order or BRICS order. So, yeah, that really, in my opinion, will accelerate de-dollarization even more because these countries, even though they're not going to get rid of all their treasuries right away, they're going to try to accumulate more and more gold because gold is the only neutral reserve asset, even though I think the yuan will be a very important currency for these countries. So that's what's going on, and it will be interesting to see how the U.S. Reacts to this, because it's a challenge to U.S. power, and hopefully it won't result in any conflict. maybe hopefully it will result in some kind of cooperation and more, more of a multipolar world.
The geopolitical fuse has already been lit, and silver is riding the shockwaves. The BRICS alliance, once dismissed as a loose coalition, has hardened into a financial weapon aimed squarely at the dollar. In 2025, BRICS expanded to 10 members, pulling in resource-rich nations like Indonesia and pushing forward their own blockchain-based BRICS Pay system designed to bypass the dollar altogether. Each step they take toward de-dollarization erodes the foundation of U.S. monetary power, and investors are noticing. Central banks in these emerging markets aren't just talking, they're acting. Gold purchases in the second quarter alone hit 166 tons, up 41% from the previous quarter, pushing annual totals well above 1,000 tons for the third year running. While gold is their weapon of choice, silver is riding the coattails as investors seek the next best alternative. Exchange-traded funds have vacuumed up over 95 million ounces in just 6 months. And the supply chain in BRICS nations is tightening, choking off flows of industrial silver. The ripple effects are undeniable. Tensions in the Middle East spiked silver prices 5% in a single month, and every flare-up in global risk premiums pushes more capital into safe havens. JP Morgan is already forecasting gold at $3,675 by year's end on the back of relentless central bank buying, while the Silver Institute warns of a massive 149 million ounce deficit. Even the skeptics admit the BRICS challenge is fueling metals, though they argue it might cap silver near $40. But that argument is already collapsing because silver has broken well beyond it. The world is choosing sides, and in this financial war, hard assets are the ultimate safe haven. But geopolitics are only one part of the equation. The real bomb ticking under the dollar lies in the sovereign debt markets.
Yeah, I agree 100% with you because long-term bonds are just fiat currency due in 20, 30, or 50 years. So the higher the yields go, that means investors are selling those bonds. They don't have as much confidence, and if they're going to buy them, they want a higher return. And Germany as well, they are at 15-year highs, I think, the 30-year there. I mean, the last couple of days, we've seen a little bit of a rebound in these bond markets, so yields have gone back down slightly. I think there's been intervention almost every day in Japan by the central bank. The Bank of England intervened as well. So they're going to try their hardest to keep this from getting worse. But I don't think it's going to work. I think the markets are bigger than the central banks. And I don't think we are out of the woods. And September, October are usually seasonally not very good months for currencies and bonds. So yeah, I would keep an eye on that. And I think, like you said, Japan is like it is a big part of this because their yields have gone from being negative to like the 30 years around 3.3%. Doesn't sound like much, but when you're coming from zero, that's...
Just before we get going, we just launched the official Silver News Daily Telegram. To kick things off, we're running a 10-ounce silver giveaway. Yes, real physical silver, not a voucher, not digital credits, actual bullion. This Telegram will be our new home for real-time silver discussions, market insights, collection picks, and everything precious metals. It's where the community truly comes alive. Here's how to enter the 10-ounce silver giveaway. Be subscribed to Silver News Daily on YouTube. Turn on the notification bell. Comment 10-ounce giveaway on 3 separate videos. Be an active member of the Telegram group and say hi. Once we hit 500 active Telegram members, we'll pick one lucky winner to receive 10 ounces of silver shipped directly to you. So get in early, stay active.
The global debt machine is breaking down, and the cracks are widening faster than anyone expected. Across the developed world, sovereign bond yields have surged to levels not seen in over 15 years. In the U.S., 30-year yields have climbed to 5% after Moody's delivered a stinging downgrade in May. Japan, once the poster child of negative rates, now faces 3.3% on its long bonds. Even Germany, long considered the safe harbor of Europe, is seeing yields touch decade highs. Altogether, global debt now stands at a staggering $315 trillion, with emerging markets suffering an additional 50 basis point surge in the third quarter alone. What does this mean for silver? Rising yields were once thought to be kryptonite for precious metals, but that logic no longer holds. The sheer scale of debt is unsustainable. Higher yields now signal fear, not strength. Investors aren't flocking to bonds. They're fleeing them, redirecting flows into hard assets as a hedge against government insolvency. Silver has already gained 15% on the back of these yield spikes, and that's before the full weight of the crisis hits. Look at how desperate policymakers have become. The Bank of Japan and the Bank of England have had to absorb nearly $200 billion worth of bonds in a single quarter just to keep markets functioning. Italy and Spain have seen their spreads widen by 100 basis points, reigniting fears of another European debt spiral. Each intervention only confirms what Ray Dalio and others have been warning. The system is unsustainable, and when confidence in sovereign debt collapses, gold and silver become the only safe haven left. This is why UBS, despite its conservative outlook, is still calling for $38 silver by year's end purely on fiscal risk. But if the debt crisis accelerates, silver won't just climb steadily. It will surge violently, and the Federal Reserve's role in this trap is about to make things even worse.
I mean, the first one, technically, technical analysis wise, we had a big move in gold at the beginning of the year. We topped at 3,500 in April. And I guess the market took a breather for over 4 months. And usually these consolidations, they end up, especially a bullish one, end up breaking back out towards the upside. The chance of it breaking down is like 1 in 4. So technically, it's just confirming the formation. Fundamentally, I guess it's related to all the turbulence in the world geopolitically, I would say, and the fact that BRICS are getting more and more united, especially after India kind of made up for now with China. That will accelerate de-dollarization, and also all the debt in the West, government debts, that's weighing on the bond market, and I think that's helping gold. And I also think the economies, not just in Europe and in the US, are slowing down. And the economy that slows down, that means less tax receipts, and that means more fiscal problems. So I think it's a combination of those things. Silver has kind of late in the last few weeks was leading gold. Yeah, I think ever since we broke like 35, 36, that confirmed the breakout. Yeah, so I'm very bullish silver, even more than gold. That doesn't mean I'm going to sell my gold to buy silver, but just keep trying to buy both.
The Federal Reserve has walked straight into a trap of its own making. For over a decade, they kept rates artificially low, inflating bubbles across housing, stocks, and sovereign debt. Now, the payback has arrived. Rates have already reverted toward their historical mean near 5%, and the market is whispering about the unthinkable. Double-digit yields if inflation resurges. Every tick higher shreds the credibility of the Fed's narrative that they're in control. In September 2025, the Fed blinked, cutting rates by 50 basis points down to 4.25 to 4.50%. They claimed it was a precautionary move, but the market saw through it. Silver spiked 3% in a single day as investors smelled blood. Real rates are still positive, but barely, about 1.25% when adjusted for 2.9% CPI. Meanwhile, long bonds sold off, pushing yields higher anyway. The Fed's cut not only failed to ease the debt burden, it sent a clear message. They're desperate, and political pressure is cracking their resolve. Former President Trump has been openly pressuring the Fed to juice the economy ahead of 2026, further eroding the perception of central bank independence. That's a dangerous signal for global investors who rely on the Fed as the guardian of dollar credibility. Goldman Sachs has already warned that if the Fed loses its grip on inflation expectations, silver could surge to $50 in short order. And Edward Chancellor, a historian of financial bubbles, has said plainly that the end of distorted rates will drive a migration into hard assets unlike anything we've seen in decades. The truth is unavoidable. The Fed can't raise without detonating the debt bomb, and it can't cut without sparking inflation and debasing the currency. They're stuck, cornered, and bleeding credibility. And as confidence in the central bank fades, faith in fiat money itself begins to collapse. That's where silver's dual role, as both a monetary hedge and an industrial powerhouse, becomes unstoppable.
Point about the British pound, because it was only in 1954 that the dollar took over the pound as the major reserve currency. And we saw recently Tavi Costa published this chart that gold reserves for foreign central banks have overtaken treasury reserves of foreign central banks. So it looks like we're in 1954, so to speak, for the U.S. What I see happening is continued devaluation of the dollar, especially versus gold. And unfortunately, a lot of dollars are going to come back to the States, and that's going to make things a lot more unaffordable for people. And that's why, and I think the Trump administration knows this, and Stephen Miron, he's been appointed as to a post in the Fed. His main theory is to devalue the dollar. So I think they are going for that. But at the same time, they're pushing for reindustrializing the U.S. As a way of maybe softening the blow, so that, yes, people are going to be hard up a bit more, but if they have new jobs, it will help. Whether if we have a hyperinflation or not, I mean, that's still up for debate, even though I think we're very close to it. It all depends, I think, as well, whether this talk of revaluation is, if they really come out and revalue gold, if they revalue it really high, then we could see the dollar really, well, because revaluing gold really high means the dollar becomes worth a lot less. So, in my view, either way, one needs to keep a hold of gold and hard assets, because it's the only way to keep moving is to devalue, because the debt is so huge. The unfunded liabilities are so huge. And that's the only way out, short of just defaulting. And defaulting, I think politicians prefer inflation to default, because default means like a Great Depression. No one has anything. At least in a high inflation, people can still buy things, even though it's not that affordable, but at least there's currency going around.
Confidence in fiat money is evaporating, and the bond market is the canary in the coal mine. In just the first half of 2025, global bond outflows reached $500 billion. A tidal wave of capital fleeing what was once considered the safest asset class on Earth. Long-dated government bonds, those fiat promises due in 20 to 50 years, are being dumped, and yields are spiking despite non-stop interventions from central banks. The U.S. 30-year yield at 5%, Japan at 3.3%, and Europe at multi-decade highs all point to the same conclusion. Investors no longer trust governments to repay without debasing their currencies. Silver, unlike paper promises, can't be printed. That's why every surge in yields this year has been mirrored by gains in precious metals. Silver alone has risen 12% in tight correlation with bond weakness, and exchange-traded funds are channeling about 10% of their inflows directly into silver as a monetary hedge. Meanwhile, central banks are fighting a losing battle. The Bank of Japan has been intervening almost daily since June, buying bonds just to keep yields from exploding. Moody's downgrade of U.S. debt in May spiked yields another 25 basis points, and each move like this only reinforces the perception that the system is cracking. Mario Innio's stark warning cuts to the heart of it. The market is bigger than any central bank, and interventions are nothing more than band-aids on a hemorrhage. A Reuters poll shows that 70% of analysts now expect silver above $40 solely because of fiat fears, and we're already there. The narrative has flipped. Bonds are no longer the safe haven. Silver is. But here's the kicker. This fiat crisis is colliding head-on with a physical supply shortage, and that's where the real fireworks begin.
There's a lot of countries, like especially the emerging market and countries like Kenya, who are swapping their dollar debts for yuan or Swiss francs because the rate of interest in yuan and Swiss francs is a lot lower than the dollar rates. I guess there's still a lot of dollar-denominated debt for the emerging markets, but it's a trend that's growing. The only let's say the other side of the coin of this is that these countries, yeah, they're paying less interest, but the currencies that they are borrowing in, like Swiss franc and yuan, they might appreciate too, and that makes it harder for them to pay it back. So it's a double-edged sword, but as for what it means for the dollar, it means that there will be less demand, especially in times of crises when liquidity dries up. The dollar might not rise as much as it used to in the past because countries won't be needing as much dollars to pay debts. Actually, it's difficult to give levels, but I have a feeling that gold and silver are going to surprise on the upside because this breakout is quite significant. And yeah, so I mean, looking at the technical picture, if you measure like the move from the beginning of the year till April in gold and you extrapolate it from the breakout, it gives you 4,300. But it could be even more in the next 4 to 5 months, I would say. I think Goldman Sachs has come out and they said they could see 5,000 if the market loses confidence in the Fed. So anything's possible, but I wouldn't want to be short gold and silver. Anyway, I don't recommend people go short gold and silver. Yeah, I agree with you. We don't need a central bank in the U.S. nor here in England. But be as it may, the people in the markets, the traders, the investors, and hedge fund managers, they don't see things like us, and they do see this dispute with Trump as a threat to the Fed's independence. They think that the Fed has been great at controlling inflation, which I think is a joke. So, but yeah, it does affect things, and it will help hard assets. So, because I think what people are fearful of is that instead of their inflation being just 2%, it's going to be 3 or 4, and that doesn't seem a lot, but it is over time.
The physical silver market is flashing red, and the shortage is becoming impossible to ignore. For the 4th straight year, silver is running a global deficit, with the Silver Institute projecting nearly 150 million ounces short in 2025 alone. Mining output has been sliding, down about 7% since 2016, while demand from both investors and industry keeps climbing. The result? A squeeze that's tightening with every passing month. Just look at the pressure points. COMEX warehouses have been bleeding inventory, with deliveries in July and August hitting record highs. Premiums on physical bullion are soaring, 20 to 30% above spot, and buyers are waiting weeks to get product. At the same time, recycling can't keep up, even with higher prices offering incentives. Industrial demand is the wild card here. Solar panels now eat up almost 1/5 of global silver demand, and with governments worldwide doubling down on renewable mandates, that share is only set to rise. Electric vehicles are another black hole for silver consumption, with each car requiring up to twice as much silver as older models. And here's the kicker. Unlike gold, most silver mined gets consumed. It's in your electronics, your cars, your solar cells, locked away and unrecoverable. Investors rushing into silver ETFs and physical bars are colliding head-on with industrial giants that need the same ounces to keep their production lines running. Something has to give. This isn't just a market imbalance, it's a powder keg. When you combine an unstoppable wave of demand with a shrinking supply base, prices don't just rise gradually, they gap higher violently. Which brings us to the ultimate question. How high can silver really go when all of these forces collide?
Yeah, I think that's what the world is waking up to, and that's why central banks around the world are accumulating so much gold. But it's not just the dollar. All the major fiat currencies have lost like 99%. I think it's only the Swiss franc that has lost like 92 or 93, which isn't great either, but in relative terms, it's a lot better. And I mean, even if you just go back 20 years, Elijah, it's like gone up 10 times, really, from it was, well, even more than 10 times because the low was 250 back in the early part of this century. I think there's a good chance because even the Treasury, well, actually the Fed, their accounting manual earlier in May, they wrote about that. And in the beginning of August, there's an essay written by an economist for the board of the Federal Reserve talking exactly about that. So they are thinking about it. What it will do to the price is put a floor at the level that they choose to revalue it to. Right now, it's at $42.22. Even if they were just to revalue it to $3,500, which is where we are right now in the spot price, that will put a rocket up even more, rocket up the gold price even more, because in 1972, they revalued from 35 to 38, and then the market just kept going up. And then they revalued again in 73 to the level that we have now. And gold took off and went to like 200 by the end of, I think, 1970. Well, I think the reason they haven't revalued it is because they want to keep gold out of the public conscience. Because if they revalue, people are going to realize that the emperor dollar has no clothes, and that gold is the ultimate reserve asset. So if you keep it there, it means you don't need it, right? It's just it's just pet rock sitting there, and it's useless. But if they revalue it, it's an admission that the fiat experiment has failed, and it was failing back in the early 70s, and that's why they had to revalue it a couple of times.
When you connect all the dots, the picture becomes undeniable. The Federal Reserve's leaked plan to revalue gold is the ultimate admission that the dollar system is breaking. BRICS nations are openly challenging U.S. dominance. Central banks are hoarding metals, sovereign debt markets are crumbling under their own weight, and confidence in fiat currencies is unraveling. At the same time, the physical silver market is running empty, while industrial demand keeps accelerating with no substitutes in sight. This is not a normal rally, it's the perfect storm. Gold may move first, but silver is the leverage play, the asset that always overshoots when the monetary system trembles. History shows it slingshots past expectations, and this time the setup is even more explosive. Could silver hit $50? Easily. Could it run toward $150, its inflation-adjusted high? Absolutely. And if the dollar suffers a true confidence crisis, the kind that forces gold to be revalued at multiples of its current price, then silver's climb toward the unthinkable, $10,000 an ounce, is not just possible, it's inevitable. The countdown has already started. The only question left is whether you'll be prepared when the reset finally hits. So stay sharp, stay informed, and if you haven't yet, make sure to subscribe so you don't miss what comes next. And remember, this is not financial advice. Always speak to a qualified professional before making any investment decisions.